Warren Buffett famously said, "Rule number 1, never lose money. Rule number 2, refer back to Rule 1." And when it comes to dividend investing, we're embracing this philosophy wholeheartedly. An ETF I've been purchasing is SDHD. This ETF aims to provide shareholders with long-term capital growth and income. It's increased its dividend year over year for the past 10 years. The dividend has grown at an average rate of 6.5% over the past 10 years. The dividend yield remaining at 3.6%. And I know, not 5%. But the share price increased by 15% year over year and has beat the S&P index consistently. So please forgive me. But this video isn't about SDHD specifically. It's about how you can find these dividends. Where do you look to find a dividend growth? Or why would a company freely give away money? I'll explore these topics and answer each question to help you refer back to rule number 1. Think of dividends as seeds you sow. Just as seeds grow into fruitful plants, dividends nourish your financial portfolio, steadily blossoming over time, providing stability during market volatility and cold hard cash over time. So what is a 5% dividend yield? Simply imagine investing $10,000 and getting $500 in return at the end of the year. A dividend yield of 5% is no ordinary feat. In an era of historically low interest rates and volatile markets, it's an extraordinary accomplishment. Companies that can maintain such high dividend yields are often well established, financially robust, and have a strong cash flow. In my example of SDHD, an ETF holds a number of these types of companies, paying a dividend which the portfolio manager will pay to each investor that holds the security quarter over quarter. The secret formula can be noted in this Warren Buffett statement. For dividend investing, it's not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. In that quote, Warren Buffett is emphasizing that successful investing is not about predicting industry trends, but rather focusing on understanding the competitive advantage of individual companies and its durability over time. By identifying companies with strong and lasting advantage, investors can make informed decisions that lead to long-term profitability. Looking back at my example of SDHD, the management team is actively looking for companies that fit this criteria, but also looking for low volatility to help mitigate large fluctuations. Now that we've covered SDHD's approach, let's talk about another hidden gem, dividend growth. As dividends grow over time, your income from these investments has the potential to compound significantly. With each passing quarter, you can see your income rise. All the while, the value of your investment appreciates as well. It's like having the best of both worlds, a reliable income stream and the potential for capital gains. A steadily increasing dividend payout over the years not only helps beat inflation, but also indicates a healthy and robust company with shareholder-friendly approach. Finding that perfect balance is very important. As investors, we find ourselves at the crossroads, torn between high-yield stocks that might be risky and growth stocks that don't offer immediate income. However, dividend stocks that pay out a ratio between 20 to 60% and offer a growing revenue strike the perfect balance. They tend to be from established companies and have weathered economic storms in the past. Additionally, they have a track record of adapting to changing market conditions. Be sure to invest with caution. While the prospect of high dividend yield and dividend growth is without a doubt exciting, it's essential to exercise due diligence, conduct thorough research, and consider the company's financials, business model, and industry trends. A high dividend yield can sometimes be a red flag, indicating potential risks or challenges the company is facing. Hence, ensure the dividend payout is sustainable in the long term. You're probably thinking, what's the catch? Why would a company want to pay out part of their profits to me? Well, believe it or not, there's a few reasons. Companies tend to pay dividends to reward shareholders, attract new investors, or they want to allocate their excess cash and benefit from potential tax advantages. Sometimes these companies are so established, they're competing against themselves at this point and really don't need to invest their extra cash back into their business. Overall, dividends play a critical role in rewarding shareholders, providing a steady income stream, and reflecting a company's financial health. Whether a company chooses to pay dividends or reinvest its profits depends on its unique circumstances and growth objectives. As investors, understanding the significance of dividend helps us make informed decisions and build a well-balanced portfolio. In the meantime, happy investing. If you want to make a great investment, make sure you hit the like and subscribe button.